Welcome. Today, we're looking at a real head scratcher in the markets. One of those days where everything looked good, but it just wasn't good enough. The market started a rally full of optimism and then slammed right into a brick wall. So let's figure out what happened. So why did the market rise only to stall out? Everything was pointing up. All the major indices were green, and then the music just stopped. It was like the party hit a ceiling, it just could not break through. We're going to unpack exactly what was fueling that climb and, more importantly, what slammed on the brakes. Okay, let's get into it. Section 1, Rally meets resistance. And really, that's the whole story of the day in a nutshell, this core conflict. It was a classic tug of war. And just look at the numbers here. At first glance, it was a pretty good day, right? All three major indices finished in the green. You've got the tech-heavy NASDAQ leading the way, up almost a full percent. So on the surface, everything looked great. But, and this is the big but, here's the problem. Despite all that green on the screen, the momentum just died. The S&P 500, our best gauge of the overall market, ran headfirst into a wall. It just could not break through that 7,000 mark. And that right there, that's the central conflict we really need to dig into. All right, Section 2, the engine. Let's talk about what was actually powering up the market in the first place, specifically with tech stocks. The fuel for this initial rally came from a really big, highly anticipated economic report. And that report was the January CPI data, the big inflation number. And guess what? It came in cooler than expected. For the markets, that is fantastic news. It's the green light everyone was looking for. Why? Well, because lower inflation means the Fed has more breathing room, right? They can start thinking about cutting interest rates. And as you know, the idea of rate cuts, that's like rocket fuel for stocks. So you can really see the positive momentum building here. First, that cooler CPI data gets everybody excited about rate cuts. Then you have tech stocks just leading the charge. And at the same time, the VIX, which is basically the market's fear gauge, it just dropped. All of these things together scream risk on. And that's what was pushing stocks higher. Okay, so that's the engine. But what about the brakes? Because that's really only half the story. Despite all that good news and momentum, something slammed on the brakes. And it all comes down to one big round number. And that number is 7,000. This is the level on the S&P 500 that basically acted like a bouncer at a club. It's so much more than just a number on a chart. It's a huge technical and, maybe more importantly, psychological barrier. It's a point where traders get nervous and start thinking, you know what, maybe I should just take my profits and get out. So why is 7,000 such a thick wall? Well, it's really two things. First, there's the simple psychology of it, right? It's a big, round number, so traders use it as a signal to cash in. But the bigger story, the real story, is the Fed. The minutes from their last meeting just came out, and they had a pretty hawkish or cautious tone. Get this. Even though they didn't raise rates, several members said they might have to hike rates again if inflation stays stubborn. Now, that is like dumping a bucket of ice water on the market's rate cut party. All right, next up, the wild card. And this is where things get really interesting. Because while stocks were in this epic battle with the 7,000 level, a totally different part of the market was sending a loud and clear warning signal, one that completely contradicted that risk-on mood we saw earlier. First up, let's talk about gold. The classic safe haven asset where investors run when they get scared. Well, it had a massive day, surging over 2%. That's a pretty powerful move. And if you thought that was something, check out what silver did. Its move was even more dramatic. It leaped over 5%. That's a huge move. So this begs the question, right? Why on earth are these fear assets, these traditional safe havens, rallying so hard on a day when stock investors are supposedly feeling optimistic and taking risks? It's basically a massive warning shot across the bow. It's telling us that under the surface, there's a lot of anxiety. Big investors, the smart money, they're quietly hedging their bets. They are not buying the whole inflation is dead story. Instead, they're buying insurance. Insurance against inflation staying hot, against global risks, and maybe even a weaker dollar. So this brings us to the deciding factor. You've got all these conflicting signals, right? The tech rally, that stubborn 7,000 wall, the crazy surge in gold and silver. It all leads us to one single event that could finally solve this whole puzzle. And that event is the PCE price index data coming out on Friday. Now, we just talked about the CPI, and the market loved it. But this, the PCE, this is the inflation report the Federal Reserve actually pays the most attention to. It's their preferred measure. So whatever this report says, Well, that's likely going to be the tiebreaker in this market tug of war. And this really lays out the two possible scenarios, clear as day. If the data comes in cool, it confirms what the CPI told us. Rate cut hopes will go through the roof, and the S&P 500 will probably get the juice it needs to blast through that 7,000 level. But if the data comes in hot, it justifies everything the Fed was worried about. Inflation fears will spike, and we'll likely see the market pull back. The stakes are pretty high.
Okay, Section 6, the playbook. So with this incredibly tense setup, with the bulls and bears locked in this fight, what's your next move? What should you, as an investor, be watching for?
So here's your action plan. Step 1, and this is the most important, just wait. Confirm what the PCE data tells us on Friday before you make any big moves. That report is the tiebreaker. Number 2, take a look at your hedges, like gold. They've clearly been working. 3, keep your eyes glued to that 7,000 level on the S&P 500. If it breaks through decisively, that's a really strong bullish signal. And finally, monitor key earnings, like Walmart's, for a pulse check on the consumer. Ultimately, the big takeaway is to be patient. By the end of this week, the PCE data will tell us who wins this fight: the optimistic engine that wants to rally, or the cautious brakes trying to hold it all back.